Hi, there's a big question going in the mind of a lot of investors that are mid cap and small cap expensive and overvalued. And the reasons for that one, in the last 5 years, the mid cap and small cap have seen phenomenal rally. The mid cap and small caps have grown by 35% per annum in the last 5 years. And micro cap, of course, has grown by 50% per annum in the last 5 years. So it's natural for investors to get worried because they think that since there's so much of return, maybe they should do profit booking, or maybe they've already run up ahead of the valuation and it's in an overvalued zone. And also adding fuel to the fire has been the media. The media has been talking a lot about it. In fact, a lot of fund managers, portfolio managers, they have been giving warning that mid cap and small caps is a big bubble and ready to burst. Now, in this video, I'll be analyzing the mid cap and small cap valuation and will try to help investors to take right decisions about them. So, a very good indicator for valuation of any stock or index or category is something called P ratio. P ratio is nothing but price divided by earning per share of that index. Now, if you look at the P ratio of the Nifty 50, it is around 22. If you look at the P ratio around mid cap 150 index, the P is 34. And if you look at the P ratio of small cap 250 index, then the P ratio is around 32. Now, if we look at the long-term average, generally the Nifty, the P ratio is around 20. So it means that Nifty is closer to the fair valuation. Mid cap, small cap, on the basis of P ratio alone, they look very expensive because 34, 32 is on the higher side, 22, 24 would have been more reasonable. So when we look at the P ratio, it gives us an indication that the mid cap and small cap are very expensive. But looking only at P ratio may not be the right thing. We also need to look at what is the expected growth in the earnings of those companies. And generally, we are okay to pay higher P ratio or higher price if the growth is much more. Now, as per research reports, the expected earning growth of Nifty 50 companies for the next 2 years is around 12%. But for the small cap and the mid cap, the expected growth is around 20 to 22%. It's almost double. And because of this higher growth, we are seeing much flows in the mid cap and small cap. So we need to look at a ratio called PEG. PEG is P divided by earnings growth. And when you divide the P with the expected earning growth, then you get the right picture. And when we do it for the next 2 years with the higher earning growth for mid and small cap, we realize that mid and small cap may not be as expensive. So according to us, according to me, I don't think that the mid and small cap is in a bubble. There is a higher earnings growth, and this is because the mid cap and small cap category has been doing well. There are a lot of sectors which are only present in mid cap and small cap, like the PLI schemes, the defense schemes, the chemicals companies, they all are under this category. So this looks very interesting. Now there's a risk also, because a big risk is that the higher earning growth which I spoke about needs to come. If the mid cap and small cap don't deliver the higher earning growth, then definitely it's a bubble. Now for investor, what should they be doing? The most important thing is that they need to look at the time horizon. If the time horizon is 10 years plus, if the corpus, if the savings or investment is being done for the retirement, for kids' education, marriage, then I think mid cap and small cap looks very interesting even in this valuation, because generally, historically in India, the mid cap and small cap, they have done well. They have given 4-5% extra when compared to large cap. This is also known as size effect, where smaller companies end up giving much higher return. So if you have a time horizon of long-term 10-year plus, then mid cap and small cap should definitely be part of the portfolio. One also needs to consider that mid cap and small cap are generally very volatile when compared to Nifty. They fall more and they also go back much more. So, between October and March, when market was falling, Nifty fell around 14-15%. We saw a correction of 24 to 25% in mid cap and small cap. But the good news is that in the rally of April, May, June, the mid cap, small cap are again the top performing. So if you're comfortable with the volatility, if you're not going to check your portfolio in short term, and if the time horizon is long term, then mid cap and small cap, according to me, doesn't seem to be very expensive, and it needs to be part of the portfolio. Thank you.